Ladies and gentlemen, it is my pleasure to speak to you today about a topic that is essential to the success of any business: basic accounting and financial statements. Accounting is the language of business, and understanding it is crucial for anyone who wants to make informed financial decisions. In this speech, I will explain what accounting is, why it is important, and how financial statements are used to measure a company's financial health. First, let us begin with the basics. Accounting is the process of recording, classifying, and summarizing financial transactions to provide information that is useful in making business decisions. There are two types of accounting: financial accounting and managerial accounting. Financial accounting is concerned with the preparation of financial statements for external users, such as investors, creditors, and regulators. Managerial accounting, on the other hand, is concerned with providing information to internal users, such as managers, to help them make better business decisions. Now that we know what accounting is, let us talk about why it is important. Accounting provides a way to track the financial performance of a business. By recording and classifying transactions, accounting helps to measure a company's profitability. Liquidity. Profitability refers to the ability of a company to generate income, while liquidity refers to the ability of a company to meet its short-term obligations. Solvency, on the other hand, refers to the ability of a company to meet its long-term obligations. Financial statements are the primary means by which accounting information is communicated to external users. There are four main financial statements: the income statement, the balance sheet, the statement of cash flows, and the statement of changes in equity. The income statement, also known as the profit and loss statement, shows a company's revenues and expenses over a period of time, typically a month, a quarter, or a year. The difference between revenues and expenses is the net income or loss. The income statement is important because it shows how much money a company has earned or lost during a specific period of time. The balance sheet shows a company's assets, liabilities, and equity at a specific point in time. Assets are things that a company owns, such as cash, inventory, and property. Liabilities are things that a company owes, such as loans and accounts payable. Equity represents the residual interest in the assets of a company after deducting liabilities. The balance sheet is important because it shows the financial position of a company at a specific point in time. The statement of cash flows shows the inflows and outflows of cash during a period of time. Cash inflows come from sources such as sales and investments, while cash outflows go to expenses such as rent and payroll. The statement of cash flows is important because it shows how much cash a company has generated or used during a specific period of time. The statement of changes in equity shows the changes in equity over a period of time. Equity changes come from sources such as net income, stock issuances, and dividends. The statement of changes in equity is important because it shows how the equity of a company has changed over time. Together, these financial statements provide a comprehensive picture of a company's financial health. They help external users make informed decisions about investing in or lending to a company. They also help internal users make informed decisions about how to manage a company's resources. In addition to financial statements, accounting also involves the use of financial ratios to measure a company's financial performance. Financial ratios are calculations that use financial statement data to measure a company's profitability, liquidity, and solvency. For example, the return on investment (ROI) ratio measures a company's profitability by comparing its net income to its total assets. The current ratio measures a company's liquidity by comparing its current assets to its current liabilities. The debt-to-equity ratio measures a company's solvency by comparing its total liabilities to its total equity. Financial ratios can be used to compare a company's financial performance to industry benchmarks or to its own past performance. They can also be used to identify areas of strength and weakness in a company's financial position. Now that we have a basic understanding of accounting and financial statements, let us consider some practical applications of this knowledge. First, if you are an entrepreneur or small business owner, understanding accounting is essential to managing your business effectively. By keeping accurate records and understanding your financial statements, you can make informed decisions about pricing, inventory management, and investment opportunities. Second, if you are an investor, understanding financial statements is essential to making informed investment decisions. By analyzing a company's financial statements and financial ratios, you can determine whether the company is a good investment opportunity. You can also use financial statements to monitor the financial health of companies in which you have already invested. Third, if you are a student or professional in the field of finance or accounting, understanding basic accounting and financial statements is essential to your career development. By mastering the language of business, you can become a valuable asset to any organization. In conclusion, basic accounting and financial statements are essential to the success of any business. By recording and classifying financial transactions, accounting provides a way to track a company's financial performance. Financial statements such as the income statement, balance sheet, statement of cash flows, and statement of changes in equity provide a comprehensive picture of a company's financial health. Financial ratios can be used to measure a company's profitability, liquidity, and solvency. Understanding accounting and financial statements is essential to managing a business effectively, making informed investment decisions, and developing a successful career in finance or accounting. Thank you for your attention.